Ed Thorp was a professor of mathematics who looked upon the world and saw not chaos but hidden patterns and solvable puzzles. For him, the great temples of chance, the casinos of Las Vegas, and the trading floors of Wall Street were not arenas of luck or mysterious forces. They were simply systems. And any system, he believed, no matter how complex, that is governed by a set of rules, also possesses a set of vulnerabilities, or leaks. He believed that if one could understand the rules of the system more deeply than its proprietors, one could identify these leaks and exploit them to gain a persistent statistical advantage. This advantage, this provable mathematical edge, was the key. With it, a game of chance could be transformed into a science of wealth creation. This video is the story of how one man, armed not with inherited wealth or insider connections, but with the power of the scientific method, set out to prove this radical thesis. We will follow his journey as he first takes on the seemingly invincible fortress of the Las Vegas casino, developing a system that would forever change the game of blackjack. Then, we will follow him to the larger, more complex, and infinitely more lucrative casino of Wall Street, where he applied the very same principles to invent the field we now know as quantitative finance. His story poses a profound and captivating question. How did a professor of mathematics, armed only with logic, a brilliant mind, and the first generation of room-sized computers, systematically conquer two of the most powerful and profitable industries ever conceived by humankind? Before we continue, please subscribe and leave a quick comment, even one word. This small action helps the algorithm show this video to more people and tells me these deep dives are worth making. Edward Thorp's journey began not in a brokerage office, but in the quiet cerebral world of academia. He was a product of the intellectual ferment of the mid-20th century, a time when the dawn of the computer age was beginning to unlock new possibilities in the fields of mathematics and science. After receiving his PhD in mathematics from UCLA, he joined the faculty at the prestigious Massachusetts Institute of Technology, MIT. It was here, surrounded by some of the brightest minds in the world and with access to cutting-edge technology, that his lifelong fascination with the theory of probability found its first great practical application. The target was a puzzle that had captivated gamblers and mathematicians for decades, the game of blackjack. At the time, the game of 21 was universally considered to be unbeatable over the long run. Like roulette or craps, it was believed to have a fixed, unassailable house edge. The source of this edge was simple and structural. The player must act first. If the player's hand exceeds 21, a bust, they lose their bet immediately, regardless of what happens to the dealer's hand. This fundamental rule gave the casino a small but persistent mathematical advantage of a few percentage points on every hand played. Over thousands and millions of hands, this small edge was a statistical certainty, a guarantee of profitability for the house. The prevailing wisdom was that no strategy, no matter how clever, could overcome this fundamental truth. Thorp, however, approached the problem from a different angle. He recognized that unlike in roulette, where every spin of the wheel is an independent event, blackjack was a game of dependent trials. The odds were not fixed, they were constantly changing. The reason was that as cards were dealt from the deck, or shoe, the composition of the remaining cards changed. And as the composition changed, so did the probabilities of the game. Thorp's great insight was that if he could track the cards that had been played, he could know when the remaining deck was favorable to the player and when it was favorable to the dealer. His theory was elegant. A deck rich in high cards, tens, jacks, queens, kings, and especially aces, is advantageous to the player. It increases the probability of the player being dealt a blackjack, which pays out at a higher rate of 3-2. It also increases the probability that the dealer, who is forced to hit on any hand of 16 or less, will bust. Conversely, a deck rich in low cards is advantageous to the dealer, as it reduces the player's chance of a blackjack and makes it more likely the dealer will successfully make a hand without busting. The problem was proving this theory with mathematical certainty, and transforming it into a practical, usable system. This is where Thorp, the scientist, truly emerged. He gained access to the colossal IBM 704, a room-sized vacuum tube supercomputer at MIT. Over countless hours, he taught himself FORTRAN and programmed the machine to simulate millions upon millions of hands of blackjack. He could test his theories on a scale that was previously unimaginable, gathering a mountain of statistical evidence. The computer's results were conclusive. His theory was correct. Card counting worked. The simulations proved that by keeping a running count of the high and low cards that had been dealt, a player could identify with statistical certainty when the edge had shifted in their favor. But knowing when you have an edge is only half the battle. The second equally critical part of the puzzle was knowing how much to bet. A player who bets the same amount on every hand, even with a card-counting advantage, will not succeed. The key was to bet the minimum when the deck was unfavorable or neutral, and to bet aggressively and in precise proportion to your advantage when the deck became favorable. To solve this, Thorp turned to the work of a Bell Labs physicist named John Kelly, Jr. The Kelly criterion is a mathematical formula that determines the optimal size for a series of bets to maximize long-term growth. It provides a precise mathematical answer to the question of how much capital to risk when you have a known edge. Bet too little, and your profits are suboptimal. Bet too much, and you dramatically increase your risk of ruin, even with a positive edge. The Kelly criterion provided the perfect risk management engine for Thorp's card-counting system. He now had a complete, scientifically proven methodology for turning the casino's own game against itself. Theory and simulation were one thing. Proving it in the real world was another entirely. Thorp needed a bankroll, and he found one in the form of Manny Kimmel, a wealthy and well-connected professional gambler who was intrigued by the young professor's claims. Kimmel put up $10,000, and the two men set off for the casinos of Las Vegas to conduct their grand experiment. This was no academic exercise. It was a field test in a hostile environment. Thorp knew the casinos would not take kindly to a consistent winner. He and Kimmel used disguises, false beards, glasses, and different identities, to move from casino to casino without being identified. The system worked with an almost flawless precision. Over a series of weekends, they systematically extracted money from the casinos, their profits mounting exactly as the mathematical models had predicted. The casino operators were baffled. They knew they were losing, but they could not understand how. Their initial assumption was that Thorp was cheating, but after watching him for hours, they could find no evidence of any illicit device or collusion. They saw only a quiet, unassuming professor playing the game with an unnerving, machine-like focus. Frustrated and angry, they resorted to cruder methods. They tried to distract him, to change the rules mid-game, and in some cases had pit bosses deliver not-so-subtle threats of physical violence. Thorp had proven his point. He had not only shown that blackjack was beatable, but that any system governed by rules and probabilities could be analyzed and solved. In 1962, he published his findings in the now legendary book, Beat the Dealer. The book was a sensation. It became a bestseller, democratizing the knowledge of card counting and forever changing the relationship between the player and the casino. For Thorp, however, this was just the first proof of concept. He had cracked the code of the casino. Now he turned his attention to a far larger, more complex, and infinitely more lucrative puzzle: Wall Street. Having proven with mathematical certainty that the casino's fortress could be breached, Edward Thorp turned his gaze from the green felt of Las Vegas to the ticker tape of Wall Street. In the stock market, he saw a far grander and more complex casino, one with billions of dollars at play, governed by a far more intricate set of rules. But his core philosophy remained unchanged. He believed that the market, like the game of blackjack, was not a perfectly efficient system. He was convinced that it was filled with hidden pricing anomalies, statistical deviations, and structural inefficiencies, that were completely invisible to the traditional investor who was focused on the crude, simplistic game of predicting whether the market would go up or down. Thorp was not interested in playing that game. He was not looking to forecast the future. He was looking for leaks in the system, for mispriced bets where the odds were, however slightly, in his favor. His search for a quantifiable edge on Wall Street led him to an obscure and largely ignored class of securities known as warrants. It was here, in the dusty, neglected corners of the market, that he would lay the foundation for the entire field of quantitative finance. To understand his revolutionary strategy, we must first define the instruments with the precision of a mathematician. First, there is common stock. This is simple. A share of stock represents a small piece of ownership in a company. Its price fluctuates based on the market's perception of the company's current and future value. A traditional investor buys a stock hoping its price will rise and sells it hoping to avoid a decline. This is a one-dimensional, directional bet. Second, there is the act of short selling. To short a stock is to sell a share that you do not own. An investor borrows the share from a broker, sells it on the open market at the current price, and hopes for the price to fall. If it does, the investor can buy the share back at the new, lower price, return the borrowed share to the broker, and keep the difference as profit. It is, in essence, a direct bet that a stock's price will go down. And third, there is the warrant. A warrant is a security issued by a company itself that gives the holder the right, but not the obligation, to purchase a share of the company's stock at a specified price, the strike price, on or before a specified date, the expiration date. For example, a warrant might give you the right to buy a share of Company X at $40 any time in the next 3 years. If the stock is currently trading at $50, that right is clearly valuable. The warrant acts as a leveraged bet on the company's future stock price. Thorp, with his deep understanding of probability and statistics, noticed a profound inefficiency. The market at that time had no reliable method for pricing these warrants. Their prices were driven by the same crude sentiments of hope and fear that drove stock prices. He, on the other hand, saw them as a mathematical problem. He began to develop his own pricing models, complex formulas that took into account the stock's price, the strike price, the stock's volatility, and the time to expiration. What he found was astonishing. The market was consistently mispricing these instruments. Due to fear, neglect, or simple ignorance, warrants were often trading for prices far below their mathematically determined fair value. This was the leak in the system. This was his edge. But Thorp's genius was not simply in identifying the undervalued warrant. An amateur might have simply bought the cheap warrant, which would still have been a speculative directional bet on the stock price rising. Thorp, however, was not interested in making bets on direction. He wanted to make bets on mathematics. He devised a strategy to isolate the mispricing itself, creating a position that was designed to be profitable regardless of which way the underlying stock moved. This was the invention of statistical arbitrage, and its construction was a work of pure logical beauty. Let us walk through a hypothetical trade to understand its mechanics. Imagine a company, Tech Corp, whose stock is currently trading at $50 per share. Tech Corp also has warrants trading on the market that give the holder the right to buy a share at $40. Let us say these warrants are trading for a price of just $8 each. Using his advanced mathematical model, Thorp calculates that given the stock's volatility and the warrant's time to expiration, the fair value of this warrant should be $12. The market is undervaluing it by $4. Here is the masterstroke. Thorp would not simply buy the warrant. Instead, he would perform two actions simultaneously as a single hedged trade. He would buy the undervalued warrant for $8. He would short a corresponding amount of the common stock at $50. He had now created a market-neutral position. He was simultaneously long and short the same company. He was no longer exposed to the whims of the market's direction. His profit would now come from the inevitable correction of the mathematical mispricing between the two securities. To understand why, Let us consider the three possible scenarios for the stock price. Scenario A. The stock price goes up to $70. His short position in the stock is now a loser. He has lost $20. But the warrant, which gives him the right to buy the stock at $40, is now fantastically valuable. Its price might soar to $30 or more. The profit from his long warrant position would far exceed the loss from his short stock position, resulting in a substantial net gain. Scenario B. The stock price goes down to $30. Now his long warrant position is a loser. Its value might fall from $8 to nearly zero. But his short stock position is a winner. He has made a $20 profit. The profit from the short stock would be greater than the loss from the warrant, again resulting in a net gain. Scenario C. The stock price stays the same at $50. In this case, as time passes and other sophisticated investors recognize the anomaly, the warrant's price would naturally drift upward from its discounted price of $8 toward its fair value of $12. Thorp could then close both sides of his trade for a guaranteed low-risk profit of $4. He had created a financial machine. He had constructed a position that was designed to make money from a mathematical certainty, the eventual convergence of an asset's price to its fair value, while immunizing himself from the unpredictable emotional chaos of the broader market. He was not betting on the stock. He was betting on the relationship between the stock and its derivative. He was betting on his model, on his math, not on market sentiment. This was a paradigm shift in the world of investment. With his partner, Sheen Kassouf, he published these findings in his second groundbreaking book, Beat the Market, in 1967. Thorp quickly realized this was not a one-trick pony. The underlying logic of arbitraging the mispricing between a stock and its related derivative could be applied to a whole class of securities. He expanded his arsenal to include convertible bonds, bonds that could be converted into a fixed number of shares of stock. Just like warrants, these instruments were often mispriced by the market. Thorp would apply the same strategy: buy the undervalued convertible bond and simultaneously short the common stock, creating another low-risk, market-neutral profit engine. He applied it to dual-listed stocks, preferred shares, and a host of other complex securities. He was a financial engineer, systematically identifying and exploiting inefficiencies wherever they appeared. But these strategies were complex, capital-intensive, and required a level of execution that was beyond the scope of a private investor. To truly scale his operation, Thorp needed a formal structure. In 1969, he partnered with a savvy and aggressive trader named J. Regan to form one of the first true quantitative hedge funds in history, Princeton Newport Partners, or PNP. The partnership was a perfect fusion of intellect and execution. Thorp was the quiet academic brain of the operation, the architect of the mathematical models and trading strategies. Regan was the master of the trading floor, the man who could execute their complex multi-legged trades in the real-world chaos of the stock exchange. PNP was a black box unlike anything Wall Street had ever seen. They did not care about a company's story, its management team, its products, or its earnings per share. Their decisions to buy or sell were driven by a single factor: the output of Ed Thorp's computer models. They were the first to bring the cold, hard, data-driven logic of the MIT computer lab to the gut-driven emotional floor of the New York Stock Exchange. This was the birth of an industry. Princeton Newport Partners was the prototype, the alpha version of the thousands of quantitative and statistical arbitrage hedge funds that now dominate the modern financial landscape. Thorp had not just found a new way to trade. He had invented an entirely new way to think about the market. He had proven that the market was not just a story to be told, but a code to be broken. With Princeton Newport Partners established as a well-oiled machine for exploiting market inefficiencies, Edward Thorp continued to push the boundaries of what was mathematically possible. His next great conquest was in the nascent and disorganized world of stock options. In the late 1960s, before the creation of standardized exchanges like the Chicago Board Options Exchange, Options were traded over the counter in a chaotic and inefficient market. There was no established formula for determining their fair price. They were priced based on gut feeling, intuition, and the negotiating skill of the traders involved. For Thorp, this was the equivalent of a casino offering a new game with no stated odds, an irresistible invitation to find an edge. While academic economists were still grappling with the problem, Thorp, working with his own unique set of differential equations, developed a formula to accurately price options. His model took into account the key variables: the stock price, the strike price, volatility, interest rates, and time to expiration, to arrive at a precise theoretical value for any given option. Crucially, he did this years before the famous Black-Scholes-Merton model, which would later win a Nobel Prize, was published in 1973. For several years, Ed Thorp and his partners at PNP were effectively the only players in the world who could scientifically determine whether an option was cheap or expensive. This informational advantage was a license to print money. They applied the same market-neutral logic they had perfected with warrants. They would find an underpriced option, buy it, and simultaneously short the underlying stock in a precise ratio to hedge away the directional risk. They were not betting on the stock's direction. They were betting on their superior mathematical model. The profits rolled in with a consistency and predictability that seemed to defy the very nature of Wall Street. The track record of Princeton-Newport partners is the stuff of legend, and it stands as the ultimate proof of the power of Thorp's quantitative method. For nearly 2 decades, from 1969 to 1988, the fund generated an average annualized return of approximately 20%. What made this achievement so extraordinary was not just the high returns, but the incredible smoothness and consistency. In an era that included the brutal bear market of the 1970s, runaway inflation, and extreme volatility, PNP reportedly suffered only a handful of losing quarters, and none of them were significant. They had constructed the holy grail of investing, a strategy that delivered equity-like returns with bond-like risk. They were a machine for generating pure alpha, returns that are independent of the market's general direction. They had proven, year after year, that science could, in fact, beat the market. The end of this golden era came not from a flaw in their models or a catastrophic market crash, but from a force that no mathematical formula could predict: the American legal system. In the late 1980s, the U.S. Attorney for the Southern District of New York, Rudolph Giuliani, launched a high-profile crusade against Wall Street corruption, with his primary target being Michael Milken, the infamous junk bond king. In their sprawling investigation, prosecutors cast a wide net, and Princeton-Newport Partners was ensnared in it. The charges against the firm and its partners were not related to their core statistical arbitrage strategies, but to a series of tax trades that prosecutors alleged were a form of fraud. The ultimate legal blow, however, came from the threat of a RICO indictment. The Racketeer Influenced and Corrupt Organizations Act was a law designed to fight organized crime, and its most fearsome provision allowed the government to freeze a firm's assets before a trial had even begun. For a hedge fund that relied on its capital to operate, the mere threat of a RICO indictment was an existential one. Thorp and his partners were faced with an impossible choice: fight a multi-year, multi-million-dollar legal battle against the full might of the federal government, with their firm's assets frozen and their business paralyzed, or dissolve the firm and return all capital to their investors. With a heavy heart, they chose the latter. In 1988, Princeton-Newport Partners, one of the most successful investment firms in history, closed its doors forever. In the years that followed, the partners were ultimately exonerated on all of the most serious charges, but the damage was done. PNP was not destroyed by the market. It was destroyed by a systemic non-market risk. It was the ultimate lesson that even a perfect investment strategy is vulnerable to forces outside the realm of mathematics. In his later years, Thorp has continued to manage his own immense fortune with the same quantitative discipline, becoming a respected elder statesman of the investment world. The final testament to his analytical prowess came from his early and unwavering identification of the Bernie Madoff investment scheme as a fraud. While the rest of the world was fooled by Madoff's impossibly smooth returns, Thorp looked at the data and saw a mathematical impossibility. As a quantitative investor, he knew the statistical signature, the fingerprints of real-world trading returns. They involve volatility, occasional losses, and a certain randomness. Madoff's returns were too perfect, a straight line that could only be drawn by a fraud, not generated by a real market strategy. He and others tried to warn the SEC for years, but were famously ignored. It was the final validation of his life's philosophy. The numbers, if you know how to read them, do not lie. The legacy of Edward Thorp is a testament to the power of a single revolutionary idea: that the great games of chance and finance are not arenas of pure chaos, but complex systems with discoverable rules and exploitable inefficiencies. From the blackjack tables of Las Vegas to the trading floors of Wall Street, he proved that a rigorous, scientific, and evidence-based approach could systematically defeat opponents who relied on intuition, tradition, and gut feeling. He was not a gambler. He was a scientist who turned the casino and the stock market into his personal laboratories. He did not simply earn a fortune. He fundamentally changed the nature of the game, launching the quantitative revolution that dominates the world of finance today. Thorp's approach was purely mathematical. He sought to find statistical anomalies in the numbers themselves, deliberately ignoring the human factor of fear and greed. But there exists another, equally powerful school of thought, one that focuses precisely on the psychology of the market and the actions of its most powerful players. To understand how to read the intentions of smart money, not through formulas, but through the direct analysis of price and volume, for those who wish to truly master the lessons discussed here, it is essential to study them from the source. Please take note of a unique new edition of Richard Wyckoff's masterpiece, How I Trade and Invest in Stocks and Bonds, by Max Davidson. It has been meticulously adapted for the modern trader, with complete explanations that make Wyckoff's timeless wisdom more accessible than ever. For anyone who wants to truly absorb the lessons we are discussing, this adapted edition is an indispensable part of your library. The link to this book is located in the description of this video. Today we have dissected the quantitative approach of Edward Thorp. But do not forget the other great schools of thought: the art of speculation and tape reading from Jesse Livermore, the analysis of market structure and the actions of smart money from Richard Wyckoff, and the deep understanding of time cycles from William Delbert Gann. Each of them offers a unique and powerful perspective on the market. All links can be found in the description of this video.